Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in roughly 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm good, Bryce.
Good. As always, we're here to chat stocks, which I'm excited about. Always excited to talk stocks with you.
Today we're here to chat books.
Yes, that is also true. You got me on the technicality.
Yeah.
So you're right, Ren. This episode, it's the first episode for the month of June. So we're going to be recapping our book club book of the month of May, which was Sam Walton's Made in America, the founder of Walmart. So we're going to crack into that with a few of our actionable insights that we got out of the book. I thought it was a good, interesting read, particularly as you and I are both in retail, Ren. It was interesting to see how he has somewhat framed and shaped the retail industry as it is today. So we'll get into that in a little bit. But before we do, we've got two things we want to raise.
Yeah, well, I've got a bit of a mea culpa to begin with, I guess.
Yes.
And for those of you who are following our stock of the year, I chose Costa Group, Australia's largest horticultural company.
Yes.
Bryce, I can't actually remember what you chose.
I went with Baby Bunting.
Baby Bunting, that's right. Australia's largest baby specialty goods retailer. And in the head-to-head battle of baby goods and fruit and vegetables, baby goods are smoking me because Costa Group had an announcement to the market that didn't go down well, and the stock price fell, from memory, about 25%.
Yeah,
So
it was a dark week for Costa Group.
Yeah, I think you can probably bank the win. Honestly, I still like the company. I still think the fundamentals are good, but they're obviously very exposed to the climate and drought, and this year a bad crop of raspberries. That was the recent announcement that made it fall again. Worryingly for Costa Group, not the first concerning announcement that's come out. So the reason I chose it as my stock of the year was it was just off the back of a bad citrus announcement, and that the stock fell, and I thought, oh, this really come home and got me. So well done, I guess. 2 years in a row, you probably have me for stock of the year.
Hey, don't concede yet. Anything's possible, but I think it's a really interesting company because the reason that they are facing these headwinds are really to do with things that are outside of their control. And as a business, as an investor, I think it's important that when you look at these sorts of companies, you take these things into consideration. Obviously, they're being severely impacted by weather conditions, as you mentioned. But you mentioned off air, Ren, that you're thinking of putting a bit of money into Costa. I think this is a classic example of, what does Warren say? Buy when everyone else is running away, or, something along those lines.
Yeah, buy when others are fearful.
Yeah. So what are your thoughts around that?
Well, we don't talk about what we're actually going to buy because it can be construed as investment advice.
Yes.
So we'll keep it general.
Yeah.
I think the one thing, if we want to get into specifics about the company, there's one thing that maybe we should be fearful of, and that is female fruit flies, scariest of all insects, in case you didn't know.
That is not what I thought you were going to say, but okay.
And I'm going to leave it at that. Now let's talk about the book.
Cliffhanger.
Female
fruit flies.
So if you think about why Costa is an interesting buy, it's because there's a mega trend at the moment in terms of the emerging Asian middle class, expected to be about 3 billion people by 2030, and where Costa and a number of Australian agricultural retailers, or Australian agricultural exporters, are uniquely placed, is that they can export into that middle class, and particularly the upper middle class and the people with more disposable income who want higher quality produce, because Australia and New Zealand in particular are seen as really high quality agricultural regions. So that's the mega trend, that's the context. And now Costa has a couple of structural advantages in that. And one of them in particular is if you're in a certain area and there's no female fruit flies, say it all does come together eventually, you don't have to do as much to your produce before you export it. I think it's called cold treatment, and a particular area where Costa grows, this could be wrong, I'm pretty sure it's their raspberries, it may be another fruit or veg that they grow, was designated this area that was like fruit fly free, and therefore it didn't need to go through cold treatment, and therefore it was cheaper to export. But unfortunately, Costa recently found a female fruit fly in one of their traps, which could be a concerning sign and for the whole region, but particularly for Costa investors, for Costa's growers in that region. So
interesting.
That's probably now. I haven't done enough research on it. I've sort of just been following the news the last couple of days, but be greedy when others are fearful is what Warren Buffett says. The oft not quoted second part of Warren Buffett's speech is unless there are female fruit flies present. So I don't know. I really think it's an interesting company. I really think obviously I've done well on A2 milk. We've told that story to death. A number of investors had done extremely well on Blackmores, Bellamy's, Treasury Wines. There's a number of Australian companies that have benefited from this booming Asian middle class megatrend as these Australian exporters export more into Asia. I think that trend's only going to continue. So it's something that I'm watching very closely. And if it's not Costa, there will definitely be other Australian and New Zealand companies that I'm looking to throw some money into over the coming years.
Nice, Ren. That reminds me, during the week, there was a great example of, I guess, taking note of news to get an understanding of investing opportunities. And I'm not sure if you're probably aware, very well read for the general news you are. So you would know about the swine flu epidemic that is sweeping through parts of Asia at the moment. And a lot of pigs are obviously going to be killed or are getting killed at the moment. And from an investing point of view, I just think it's a good call out that a lot of beginners always ask, where do you get inspiration for stocks? Where are you finding your stock picks? That's a classic example of understanding what impact this is going to have on pork prices. Obviously, if thousands and thousands of pigs are being killed, then the demand is still going to be there for pork, but the supply is going to be less. So from an Australian point of view, if you're a pig farmer in Australia, it could be very good news as the price of pork is probably about to start shooting up quite rapidly. I don't have any companies in mind that are directly related to that, but I'm sure you could do some research and find out. But I think it's just a good call out, taking a note of what's happening in the world and from a news perspective and relating it back to investing. So
100%. It's actually part of my day job is involved in the African swine flu.
There you go.
Yeah, we are. There's certain things that every Australian retailer needs to do to stop it spreading, and so yeah, I'm well aware of it, and it's not in Australia, thank God. So yeah, Australian pork producers would be a good one. I'm pretty sure that you could just trade pork futures as well.
Bit complicated,
I'm not sure if you can.
Yes.
I'm not sure if you could trade that in Australia, but I'm pretty sure that they exist in America. Probably not for you and I and the beginner investors, but
no,
more sophisticated investors if they want to benefit from it. But yeah, I think pork is the number one protein in China, just by amount consumed. And I think, we're up to millions of pigs that have had to be put down, essentially, because they need to stop the spread of this virus. So pretty concerning.
Yeah.
It's sort of like we don't want it to spread globally and be a, mad cow, bird flu, that kind of thing. But you're right, in crisis there's always opportunity. So Bryce, as the cold-blooded capitalist that he is
Come on.
looking for the opportunity.
Carl, Speaking of pork, I was out to dinner last night, Ren, and had a delicious pork belly at a Thai restaurant with a few mates. And one of them, who is a listener of the show and started his investing journey, was showing me a couple of stocks that he's been investing in. It's always great to chat stocks with mates. You get a really good idea of where everyone's getting ideas and what they're thinking about. And he alerted me to one that has had a great market update very recently, and its stock ticker is EOS. It's called Electro-Optic Systems, and it's heavily involved in space and defense. So quite a specialized company. They do things, to do with space debris and satellite management solutions. They have IP and sort of software that controls weapons systems and ancillary products and a whole bunch of sort of IP related stuff to do with the military. And obviously it's all about contracts for them. So recently they were awarded a few contracts that has really, I guess, built out their pipeline for the next few years, and they released an update that says they've secured sufficient orders and market momentum to maintain a compounding growth rate of over 45% beyond 2020. On the back of that, the stock rose about 27%. So I think it's just another great example so Cam did some research. He was really interested in this space, found this company, put some money into it, and was very fortunate that they have released this statement, and he's doing very well on the back of it. But it's a company I'd never heard of, and we can now add it to the watch list. So just thought I'd call that out.
Nice one. A word of caution for all investors out there: relying on companies that rely on contracts, especially big military contracts, there is always an element of risk because so much of their commercial outcomes are dependent on other people's decisions that they have no control over. One company that I took a bit of a bath on, if we're going to be really honest here, is Adacel, ASX code ADA, who similarly made like flight simulation, air traffic control training software for all these militaries and all these civilian aviation authorities around the world. And it looks like they have a really structural advantage because there's a network effect if everyone's been trained on the same system, and their technology was supposedly far better than everyone else's. But as soon as that might all be true, but as soon as they start losing contracts, then everything sort of falls apart. So
good call.
I like it. I'll definitely add, what was it, EOS
Yes.
to the watch list.
Yeah.
But just a word of caution about relying on big contracts for big chunks of your revenue.
Okay, Ren. Well, we're now halfway through the podcast and we haven't discussed the book at all. We have been talking stocks, so that is good. No harm in that. So let's quickly whip out this book review, and then we'll wrap it up, so that we stick to our mantra of 20 minutes or less.
Okay, so everyone will have heard of Walmart. If you've ever been to America, you probably set foot in one. Sam Walton was the founder of Walmart, literally started with one store and just grew it from there. To give you some context, today it does over $500 billion in revenue, $514 billion in revenue last year. That is so much money. It's
mind-boggling,
When you think the Australian economy is, a couple of trillion, a few trillion?
Yeah.
And Walmart alone is doing $500 billion in revenue. So, do you want to, everyone sort of gets the Walmart story, I guess. Do you want to just kick in straight into actionable insights?
Yeah, well, I just want to frame it from the perspective of, as I said at the start of the show, both in retail as a day job. If anyone would like us to do Equity Mates as a full-time job, our details, send us a check. We can get that going pretty easily. But so I think it was, from my perspective, it's not necessarily an investing book as such, but it was a really good insight into the way that a really good manager goes about running a business. And he's one that you would want to find and invest in, I think, for me, the biggest standout was his continuous desire to learn and disrupt, both from learning from his customers and also learning from his competitors. He was ruthlessly competitive when it came to almost crushing his competitors and being disruptive and always trying new things to, I guess, break new ground. And I think from an investor's point of view, if done well and managed correctly, then it obviously has huge advantage when it comes to market share and growth. So I think that was probably my biggest takeout from the book. In terms of actionable insights for me, Ren, he was just non-stop learning. As I sort of just said, he was learning from mentors, he was learning from books, he was learning from his competition, as I said, and I think his relentless focus on the customer really drove all that. So before I go into detail, is there anything from your point of view around those points?
No, you go into detail and then I'll give you mine.
Okay, well, I think a few things that I want to point out in terms of the size that I picked up out of the book, in case the 500 trillion is not big enough for anyone, but this was in
500 billion.
500 billion, sorry.
500 trillion would be huge.
So in 1991, I always love these stats, so I picked these out of the book. 1991, Walmart sold enough men's and women's underwear and socks to put a pair on every person in America, with some to spare. 1/4 of all the fishing line produced in the US, which was about 600,000 miles at the time, was enough to go around the earth 24 times. That's how much fishing line they sold. They sold 55 million sweatsuits and 27 million pairs of jeans, and 20% of all the telephones bought in the US came from Walmart. So pretty phenomenal stuff. But that's just goes to show the size of the business. And one quote that I pulled out of it, Ren, and this is a famous quote, I guess, all around the world in retail, is Sam says, "There is only one boss, and that's the customer." He says he can fire everybody in the company from the chairman on down simply by spending his money somewhere else. So just goes to show you the way that he put importance on delivering for the customer. And I think you can see how that message carries across to retail today, especially with Amazon, and how Jeff Bezos is incredibly vocal about his relentless pursuit for customer satisfaction, almost at the expense of anything else, and it's paying dividends. So, yeah. What are your thoughts?
One. I don't actually know if he is paying dividends, but... So I probably took 3 actionable insights away. And I know you said it's not an investing book, and in the strictest sense, you're right. I think there are definitely lessons that we can learn and we can apply in our analysis. So that's sort of the way that I've approached this.
Yep.
What are the hallmarks of this business, one of the most successful businesses ever, and how do we apply what he's done here when we think about other businesses? So first one for me is slow and steady wins the race. We often love the stories of exponential growth, but the Walmart story is the opposite of that. It's of really sort of structured, almost conservative, but really clear-sighted and planned growth. So to give you some context, in 1962, Kmart, Target, and Walmart all opened. Within 5 years, Kmart had 250 stores and $800 million in sales, whereas Walmart had 19 stores and $9 million in sales. So Kmart shot out of the blocks extremely quickly, Walmart a lot slower. By the time they were both public for 10 years, so they went public at different times, but when they were both on the public markets for 10 years, Kmart had 500 shops and was doing $3 billion. Walmart had about 50 shops doing about $80 million. So again, just like wildly different sizes and growth trajectories. But at the end of the day, Kmart fell over in America. From memory, it got bought by Sears in like the early 2000s, and now Sears has gone bankrupt. So Kmart is, not much of anything anymore. Whereas Walmart, that's part of the reason why, was because it was conservative in its growth and invested sensibly, continues to just grind it out and continue to grow to this day. So I think there's definitely a lesson there in being patient with your money and finding managers that are really using their capital efficiently. So that was number one for me. Number two, and this sort of follows on from that first part of the story, the Kmart story. So number two is look for companies that are investing in technology. And one of the hallmarks of the Walmart story is that they invested in technology before any of their competitors did. So in the 1970s, Kmart's management were quite change averse, especially in regards to technology, whereas Walmart were investing in new IT systems, and they even invested in a satellite in the early 1980s. So think about that, like only 11 years before the NASA had landed on the moon, and at that stage, not even America's biggest retailer, but one of America's big retailers was investing in a satellite to send into space. Like, they were on the cutting edge for a retailer, and it paid dividends, literally. So Sam Walton, when he wrote the book, said the fact that it took about 3% of a product's price to move it through their supply chain into shops, compared to 4.5% to 5% for competitors, was testament to their investment in technology to drive the cost down. And when you look at the outcome of that, it's just that Walmart is so much cheaper than any of their competitors. It's just a really long-term structural advantage that they have because they invested in technology and because they continue to invest in technology to lower their cost of doing business. So I think the second actionable insight is look for those companies that are making those capital investments to drive down their costs and become really much more efficient than their competitors. It's all good and well for your company to pay dividends or to buy shares back, but the companies that are making the long-term investments with that capital instead are probably the longer-term companies that you want to hold. So that's 1 and 2. Number 3 for me is probably a bit more retail specific, but I do think it's important in whatever business you're in, is that for Walmart and for Sam Walton in particular, there was a relentless focus on being merchandise driven rather than being operations driven. And so what that means is, operations are all about finding, ways to cut costs today, and being a merchandise driven business is finding ways to just grow sales. And obviously every company needs a balance of the two. But I think where Walmart did really well was it empowered its team to really go out there and sell as much as possible. And I think in whatever business you're in, you want to find businesses that have that attitude rather than are just cutting costs to keep their profit margins at a consistent level. So for me, the 3 big actionable insights were: 1, sometimes slow and steady is better than exponential growth. 2, look for companies that are making those long-term investments in becoming more efficient than their competitors. And number 3, don't look for companies that are just cutting costs. Look for companies that are consistently trying to grow their sales.
Love it, Ren. Nailed it, as always.
And similar to you, the quote that I pulled out was almost exactly the same theme as yours. So the quote I have is, "Business is a competitive endeavor, and job security lasts only as long as the customer is satisfied."
Very important in retails, well, in any business really, is to ensure that at the end of the day you are satisfying your customers' needs. Otherwise, you won't have a business for very long. So, great book, Ren. I enjoyed reading it. I think it's certainly worth the read for our listeners. It's not a massive book. It's certainly no Titan. It's easy to get through and quite entertaining, I think. Great insight into one of the best retailers the world has ever seen. Huge call, I know. But
no, I think that's almost a conservative call. I think that's undisputed.
Oh, well, there you go. And even today, Walmart still staggers me in the way that it continues to grow at the rates that it does, considering its enormous size. So just a phenomenal business at the end of the day. So we'll put it up.
I think, sorry, just to interrupt, anyone who works in retail, you would do well to read this book.
Yeah, absolutely.
Outside of investing and outside of equity mates, I think it would almost be, if I had a team under me, it would be a must read.
No, I agree. I'm sure almost every retail CEO has read this because there are a lot of similarities in the way that they run their businesses today. So we're going to put it up on our website. It's going to be on our book section. Head there if you want to check it out. We'll have a link so you can go and buy it and add it to your collection. Well worth the read. So Ren, for our book club of the month of June, what book are we going to do?
It's your choice this month, isn't it?
It is. So leave it with me. Haven't thought about it.
So if you snooze, you lose, Bryce. I'm gonna nominate one this month.
Okay, hit us up.
It's called Devil Take the Hindmost. It's a history of financial speculation by Edward Chancellor.
Nice.
And essentially it is a historical look at a number of financial bubbles throughout history. So,
all right, well, let's lock it in. We'll have that up online as well. So if anyone wants to read along with us, they can do so. And that brings us to the end of the episode, Ren. So always good to chat stocks. We did chat stocks in this episode at the start, probably more stocks than book, but that's okay. Just like doing what we should for retailers do for their customers, I think everyone appreciates us chatting stocks. So let's leave it there unless you have anything else to add, and we'll chat next week.
Sounds good.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.